We're into an era now where politics trumps the economy and trade. So there is a lot of uncertainty baked into that.
Healthcare is a bit of a beaten up sector globally, mostly because of RFK Jr. Getting into power.
I mean, the one thing we can be sure about with the Chinese economic statistics is that they're basically lying.
An area that I think is quite attractive at the moment is the smaller capitalisation companies.
Kia ora, welcome to Shed Lunch, brought to you by Sharesies. I'm Helen Mattison. Today we look at what investors need to be thinking about as we navigate 2025. The risks, the opportunities and plenty of unknowns. I'm joined by Harbour Asset Management's Leva and Businessdesk founding editor Pattrick Smellie. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome Pattrick and Chris.
Hi, nice to be here.
Thanks, Helen.
Let's start with the US. I must say for listeners and viewers that we are doing this on the inauguration of Donald Trump, just with that caveat that we do know things may have changed since then. Chris, we'll start with the markets. The US markets have gone incredibly well over the last little while. Many investors are sort of questioning how far can the US go? Is it overvalued? And the tech titans do seem to have a dominance. So are there alternatives?
Yeah, so just touching on the US market first, valuations are high. Okay, so we're currently trading at about 25 times backward-looking earnings. That is a very high multiple. The issue is multiples don't tell us a lot about returns for, say, 2025 or even 2026. The real information that they give us is longer term than that. So we know that current valuations typically have led to, at these levels, quite subpar returns over 10 years. So then we go back and look at the overall market valuation and say, what's driving it? While the Magnificent Seven or the tech titans or the AI hyperscalers, they get all the press, what slips really far below the radar is actually the valuations of US companies are quite high across the board. So there's very few sectors in the US that are not trading at their top decile valuation-wise currently. Lots of people talk about Nvidia, Amazon, Apple. They're trading at about 30 times earnings. But if I look through the US market, there's companies like Walmart that are trading at over 30 times earnings. Constellation Energy, a nuclear energy company, that's trading at over 30 times earnings. Financials, banks, they're trading at the highest valuation level that they had since the global financial crisis, or obviously preceding the global financial crisis. So I think it's an oversimplified kind of narrative saying it's just the Magnificent Seven. So if you look at financials, you say, why is that so expensive? It's because one of Trump's big policy platforms is deregulation, and that benefits highly regulated sectors. Outside of the US, a lot less pressing. An area that I think is quite attractive at the moment is the smaller capitalisation companies. They're trading at a record low relative to larger cap companies. And the key thing that's really held these companies back has been that they tend to be more indebted with floating rate debt. So they've really felt the full brunt of those bond yields going up. Now, we've probably seen the worst, in my view, in the moves in bond yields. And, that should benefit those companies. Those companies are also more cyclically exposed. So they need a strong economic cycle. And actually, when we look at the US, their economic cycle looks really, really strong. So that's for investors looking at a bit more value outside the top end of the market, which is really quite expensive in historical terms.
With Trump coming in, though, there are lots of unknowns, and maybe the deregulation, you say, is what is fueling this. But Pat, what do you think in terms of where it might go?
So one thing we know about Trump is that we don't know what Trump will do next. But the one thing we can be sure about is that anything that Trump does will be self-interestedly pro-American. So that whatever he does, you can bet on it being something which is basically nakedly self-interested and therefore probably good for the American economy, notwithstanding the fact that I don't quite see how, unless he gets a different person to run the US Federal Reserve, you can cut taxes, impose tariffs, and chuck out a whole lot of people who are currently working illegally in your workforce and not have an inflationary burst. Now, I don't think that even Donald Trump can stop inflation with that particular triumvirate. Perhaps the question is, will the American economy, because it's so strong anyway, just kind of override that, and so the inflation becomes a bit of a break as opposed to a major problem for the growth trajectory for the United States.
Where does it leave world trade, though, and probably more likely Australasia? I mean, the tariffs, there's been a lot of consternation here about what might happen.
Well, Trump was a protectionist. Biden was even more protectionist. We've had more protectionist US federal settings now for the best part of a decade. More of the same, I don't necessarily think makes a huge amount of difference to New Zealand's ability to sell exports into the United States. I'd be a bit surprised if services were to be heavily hit by tariffs. My impression anyway is that it's a manufacturing and goods play rather than a services play. So to that extent, maybe it's a good thing we never got a free trade agreement with the United States because, we do know though that in the last Trump administration, we had steel tariffs put on New Zealand-produced steel, which was sort of insulting rather than economically debilitating, though.
Chris, do you have any thoughts on that?
Just on tariffs, yes, he's doing it to be pro-American, but we've got to be careful here because when we look at some of the large companies in the US, the amount of revenue that they generate from offshore is really quite high. And we know, one of the other things we know about Trump is that one of the biggest measures of popularity that he uses is the US stock market. So that gives me some comfort, at least, when I look at these, and it's even the Magnificent Seven, the amount of income that they generate from offshore is really quite high. So since he does like the stock market, sees it as a good barometer, that might temper some of his enthusiasm when he's looking to, hopefully not go all out reckless on this.
Crypto is his big thing, though, isn't it? So that's one aspect of markets.
Yes, and it's an aspect which it's an interesting aspect in the sense that Bitcoin's at over $100,000, and it's one of those asset classes where people like myself in traditional finance, we sit there and scratch our heads, and quite frankly, we've missed it. If someone asked me 5 years ago, what did you think about crypto, I'd probably espouse the same views as the likes of Warren Buffett, who doesn't have a horribly favourable view of that particular asset class. But the reality is we've kind of all been wrong, right? It's gone on longer and been a lot more successful than anyone could have thought. And that anti-fiat or anti-establishment sort of form of holding your wealth has found favour with a bunch of different people and even institutions in the US.
And here.
And here, and interestingly enough, it seems that both Donald Trump and Melania Trump have, found a way themselves to generate some.
I actually think that's quite dangerous for both of them because it reminds me so much of the NFT phenomenon.
Oh, yeah.
Remember when you're sitting around in COVID and everyone was buying NFTs and saying it was going to be, having this Mickey Mouse thing in a digital form was going to be incredibly valuable. Where are they now? I don't think anybody talks about or trades NFTs. They're like Yu-Gi-Oh cards or something like that. So there's crypto and there's crypto. I mean, Bitcoin is one thing. Some meme stock, meme crypto that has been made up around a particular individual. I mean, the reality of Trump is that he's, as they described in the New York Times today, he actually starts as a lame duck in the sense that the longer his term goes, the less significant his influence will be because he can't stand again. So he will be, he's going to flood the zone with all kinds of populist and economic things in the first 9 to 12 months because he has to get going fast and because he also just wants to overwhelm such opposition as there is, just have too many things going at once, sort of Roger Douglas style. Nobody knows what's coming next, and so you're in a constant state of confusion and terror. But as time goes on, he becomes less and less influential. Somebody has to replace him. What happens to your meme crypto at that point?
AI has had a phenomenal amount of success in recent times, and we can't not talk about that when we're talking tech.
Yeah, I mean, there's two things with megatrends. The first one is to decide whether they are a megatrend. Right now with AI, we're going through the capital expenditure cycle. There's very little revenue being made from it, outside, say, Copilot with Microsoft and some search engines. And companies over the next years are going to determine whether this is a good use of capital or not. Because you read the headlines and there's hundreds of billions of dollars going towards AI. At the end of the day, there needs to be monetization to justify that capital expenditure. Now, the other thing to bear in mind is we're so bad at picking megatrends in an early stage. And I always think of the example of AT&T asking McKinsey to go out there. This is in the late 80s. They said, look, mobile phones are taking off. How many will there be in the year 2000? McKinsey came back and said, look, we think there'll be about 900,000 mobile phones in the year 2000. There was well over 100 billion mobile phones. So even very smart people at McKinsey struggled to figure that one out. That's the overall trend. But then there's making money from the trend. And that's a really tough thing too. Because in the late 80s, early 90s, you would have said Motorola or Nokia. That's going to be the preeminent phone company. In the early 2000s, I remember my first work phone. It was a BlackBerry. It was great. And they looked like they were going to assert dominance. And then out came the iPhone. When the iPhone first came out, people were laughing at it because they said, oh, God, such an expensive phone, it doesn't have a keyboard. Our thinking changes so much with these trends. So that's the cautionary note with these new megatrends.
I think you may disagree with me about this, Chris, I don't know, but I think there's also an OpEx question with AI. Artificial intelligence to produce an answer has to use energy to produce the answer. The deeper the question, the more energy it uses. And these things are starting to suck an enormous amount of electricity out of grids everywhere that they're being used. So I suspect that there will start to be a metric which will be, what is the cost per answer for your question? And it'll be the person with the lowest cost per answer in energy terms, and therefore cents per question, who will win. And if it becomes clear that artificial intelligence just becomes more and more of an energy chew, it's going to be harder and harder to make the case, as you said, for where the use cases are, where it's actually sufficiently valuable.
That climate question is pretty intense. I mean, there's lots of consternation about what might happen. I suppose it's a bit of a wait and see. I mean, some of the bigger players are saying they're working towards mitigating that. I don't think we've seen a lot, though. It just seems to run ahead of its own steam, if you like.
Well, I suspect we're in for a couple of years anyway, where the whole focus on climate change, sustainability, the idea that there's brand value and so forth in climate change action is actually diminished. because of what we're seeing in the United States, because of the push to the right of the political spectrum, you know, BlackRock, American banks, all these big players pulling back from a kind of a breast-beating approach to their climate change obligations. I mean, basically, that the United States is, at the moment, as the world's most powerful economy, is saying we've stopped caring. And a lot of people are going to take a lead from that, because ultimately it's difficult to care about climate change. So I worry a bit that the sustainability trend is going to be quite hard to sustain, it, particularly as a branding proposition, in quite the way that it has over the last 10 years.
Even here in New Zealand, I mean, they're looking at changing the climate reporting. That could have consequences there too. Yeah. Just thinking too about other trade partners besides the US, I think they're our second biggest trade partner, but China obviously is the big powerhouse, and there's obviously been a lot said about the slowdown there, but it'd be quite good to get an idea of where that is actually at. To get anything out of the Chinese government is quite tricky. I've seen a number of reports about economists and like being muzzled when it comes to gross domestic product, which is, you know, a typical measure of an economy, good or bad. Where do you see that going, particularly for New Zealand, but also for Australia too?
I mean, the one thing we can be sure about with the Chinese economic statistics is that they're basically lying. You know, the Communist Party wants us to believe that they're growing at about 5%. They'll be lucky if they're doing 2.5%. So the Chinese domestic economy is weak. If there are tariffs imposed at the 60% level, it'll be that much weaker. But at the same time, I can't see circumstances under which the Chinese Communist Party government doesn't hold hands in such a way that it continues to keep basic consumer demand in the Chinese economy ticking over. And to the extent that New Zealand, anyway, perhaps less so Australia, where they're into hard minerals and so forth, but New Zealand, we're selling protein. So, and we're selling commodity protein mainly. So unless the Chinese decide they don't want to, you know, stay healthy, or that they're earning so little that they can't afford protein anymore, I think we're probably okay. And I suspect that if the flow of Chinese goods to the United States is cut off to some degree, we'll probably see cheaper stuff here.
Chris, have you any thoughts on that?
Structurally, China's still in such a hard spot. I think we're so used to, out of China, waiting for these big bazooka stimulus announcements. And, you know, essentially since COVID, they've just disappointed and disappointed and disappointed. And that's because there's some really big structural issues there. The mechanism of which they provided stimulus to their people was through property. But unfortunately, that can only go on for so long. And it went on to a point at China where they inflated quite a large bubble. And they don't have the population growth anymore to paper over the cracks. So, you know, I think it's not a 1 year, 2 year kind of cycle that we have to think about in China. No, I think it's the next decade. I think they're really struggling to stave off deflation. It's starting to look a little bit like Japan did in the late 80s, and they're an economic case study of just how tough it can be to get your economy going after you've had quite a substantial asset price bubble. We can kind of feel in New Zealand, there's probably some parallels with property. As I talk, I think, oh, goodness me, my house price hasn't done anything. It's gone backwards over the past 3 years. And like most Kiwis, I look at it and go, well, I feel less wealthy. People definitely aren't going to the insurance broker like they did in the 2020, 2021 and going, hey, I'd love to put a spa pool, a new car, boat, insert fancy shiny thing here on my mortgage. So, us as Kiwis, we understand the positive stimulus that a rising property market can give us. And that's where they're really struggling in China. And some of the multiples of house price to income, rental yield in some of the tier 1 cities are looking just as acute as Japan in the late 80s. So I don't think it's an easy fix in China. I really like it when I hear governments talking about diversifying our trade partners and looking at what we can do to decrease our reliance there, because I think it's going to be pretty tough going in China for quite a while. I completely respect what you've said, Pattrick, about I'd much rather be exporting what we do to China than what Australia's exporting, which is far more reliant on the construction cycle.
Maybe the thing we can't expect is for Chinese tourism to recover.
Yeah.
Domestic budgets in Chinese households are stretched. They're not going to be going, let's go to New Zealand for a couple of weeks.
So again, alternative markets is what we need to focus on.
Yeah.
Chris, what about Australia? I mean, with lots of investors thinking the US is the best thing, there's not a lot happening in the NZX for a lot of people on Sharesies anyway. ASX, it's always been known for its miners, but is that changing? And is there value in some of the other types of sectors and stocks, do you think?
Yeah, so I'd break apart Australia into three parts. So they've got these two really big sectors. So you've got banks, and the yield curve has steepened over the past 6 months. That's great for banks. It's great for their business model. They tend to lend long, borrow short. A steep yield curve is exactly what they want. That hasn't been lost on the market. Australian banks at the moment are more expensive than they've ever been relative to history. Miners, again, it's that China link. We're a little bit apprehensive there on the reliance. And then there's kind of everything else. That's a third bucket. There's quite a few healthcare names we like in Australia. Healthcare's a bit of a beaten up sector globally, mostly because of RFK Jr. Getting into power in the US in that key healthcare role. That's kind of sent shockwaves through the healthcare sector. The other one is the impact of the GLP-1 weight loss drugs. That was tipped to impact a lot of healthcare companies. So any company involved in the likes of kidney dialysis, for example, completely sold off because GLP-1 was seen to be quite a promising healthcare development in that particular area. But yeah, there's a number of companies we like in Australia in that healthcare space that have been, I suppose, caught up by that negative global healthcare narrative.
So you're saying they're cheap at the moment?
Yeah, they are cheap relative to history. But our style is to not kind of go after purely cheap companies. Yeah. The growth has to be there too.
Thinking about our own market, the NZX, it's no secret that it has been having a tough time. We did an index just recently, the Sharesies Index, which is a quarterly sort of litmus test of what investors are thinking, where they're putting their money in terms of confidence. And 9 out of 10 of the stocks that people were investing in, they are no longer, because it is NZX and the US and to a lesser extent Australia is taking their money. Just wondering what you think about where things could head for the NZX. There's been a lot of people talking about, we need to put fire under it, we need to do something else or alternatives. What's your perspective?
This is not just an NZX problem. Lots of exchanges around the world, publicly traded equities generally have been out of favour. I mean, so much private equity activity now. NZX is a very small market. I mean, I've been reporting the NZX since 1983, so I've now carbon dated myself. And the daily turnover is not that much more today than it was then, from my recollection anyway. My personal view is that it's got to get closer to the ASX. If it's got to be called the NZX, fine, but we need to be part of a much bigger, more liquid market. And you can see New Zealand companies voting with their feet on that. We've got a number of the more interesting New Zealand companies. I think of Aroa Biosurgery, for example, good example of a company which should have a lot of growth potential in the health sector, based in Auckland, listed in Australia. And those companies which make it into the big indices for passive fund indexes and so forth, passive fund managers and so forth, are almost all dual listed on the ASX. So I think we've just got to get over ourselves a wee bit and say it's a small market, how do we get a multiplier effect out of it, while also saying, yeah, it's important that we have a capital market that works in New Zealand.
What about our currency? We know the Kiwi's been tanking, if you like. The Aussie hasn't been doing that well either. What should investors think about there? I mean, good for our exporters, but...
I mean, just looking at levels, the way to think of the US dollar is, it kind of operates like a smile. So what I mean by that is when the world is fearful, things are going really, really badly, the US dollar is really, really strong. So that was like 2020, right? And when kind of the global economy is kind of trucking away okay, the US dollar will tend to weaken. But then there's another scenario when the US economy is really, really strong and other global economies are really, really weak. People want to hold the US dollar. That is where we are today. Yeah. The theme of US exceptionalism, at the end of last year, we've got a stack of outlooks from all the global investment banks. I couldn't find one of them that thought the US wasn't going to be the best performing economy in the world. And that's really showing in their currency at the moment. You've got economies like here in New Zealand that have priced in a fairly aggressive rate cutting cycle to around 3%. We've got inflation relatively under control. The US, it's not quite there yet. They're still printing, high 2s, low 3s, depending on the measure of inflation that you're looking at. Our view at the moment is that actually there's a lot of good news priced in to the US dollar. Really high consensus view that the US is going to go very well, and that means that at current levels, we actually see it as relatively attractive. I think for investors, the key thing they've got to consider is that your shares aren't the only thing that generated you returns last year. It was the currency that your shares were held in. So a lot of people who are holding these US shares directly, they've got a great return. They've got 20 odd %, but then they've got another, call it 12 from the currency on top of that. So while we focus so much on the, picking a good stock, actually the currency that you're picking it in is really key as well. So I think for investors, that is the key thing they have to take into account. How much of my money is wrapped up in a currency that is quite expensive relative to historical levels.
Thinking about coming back to New Zealand, and we can't have a conversation really to think about the year without talking about interest rates. Here, it's easing, and it's looking like we're going to get another rate cut in February. Pat, just what's your perception on whether or not that has provided the relief that businesses who have been doing it quite hard here needed? Mortgage holders, they're the next ones on the list, I suppose.
My presumptions on that are pretty bog standard. You drop interest rates far enough, and it will have an impact on economic sentiment, and you will see something of a recovery. I just worry a little bit that in New Zealand we've got something a little bit more deep-seated going on. We had a round of tax cuts last year, which nobody seemed to notice. We saw reasonable electronic card spending over Christmas, but wasn't anything to write home about, but it's coming back a wee bit. But I sense more that, I was trying to contrast the American inauguration. We've got a president, no matter what you think of him, who is telling a big story about what America is going to become. In New Zealand, we have a government that is struggling to tell a story about what New Zealand is going to become. And a lot of New Zealanders are worried that New Zealand is becoming a place that people will leave. We go through these cycles. This has been reminding me for a long time about the sort of 3 or 4 year period around the early 1990s when it just felt as if New Zealand was going down the drain and it was never going to get better. And then sort of one day the sun came up and you thought, actually it's not that bad. But there's still not a narrative or a sense from this government as yet that they actually know what to do to make the place grow. Just relying on interest rates to get everybody back into the warehouse in Mitre 10 isn't enough.
I think there are some green shoots, though. I mean, a measure that we look at a lot is the own activity measures within business confidence surveys. They've bounced off lows, and typically that has had quite a strong forward-looking relationship with GDP. I think housing is just so key here. So if we get those interest rates coming down, if I look across the Reserve Bank, I look across the main bank economists, if we get the between 5 and say high single digit house price appreciation, that starts getting back a bit of wealth effects, a little bit of animal kind of spirits into the market and into the economy. So we can't underestimate just how strong our alliance is on property in New Zealand, and just how intimately our wealth effect is tied to that. I think the good news for a lot of investors is within the NZX, a lot of that is priced in. So you look at our cyclical companies; they're trading at really low valuations. So think of the likes of the likes of Fletcher's. They're a key one. Where people don't have high expectations for our cyclical companies. Same with the retailers, Warehouse, Kathmandu, Briscoes the other day. It's all been relatively weak. That's now baked into share prices. So while the New Zealand economy doesn't look particularly good, I can remember being here on previous episodes, and I wasn't confident enough to kind of pick a turning point for New Zealand. We have picked a turning point for New Zealand over the past few months, and actually moved to relatively finding the New Zealand market more attractive than the global share market. So just a little warning out there. New Zealand economy may not look great, but actually, if you look at our share market, it's not a great reflection of the New Zealand economy at all. And actually, the individual companies within there are quite reasonably priced. And although it's hard to find a turning point for those cyclicals, you're not paying a high valuation to be in them at the moment anyway.
If we are at the bottom of the cycle, then this ought to be the time to be thinking hard about whether a cheap stock is worth buying.
So what is the recommendations for investors, you think, this year then, with all of that?
I think bonds actually still look good. So,
Yes,
yields, and you've got to think about the risks that they're hedging you for. So, if you look back to 2022, everyone says, bonds didn't work, my equities went down, my bonds went down, it was just horrible, there was no diversification. Bonds don't insure you for an inflation shock. They insure you for a growth shock. And right now, the consensus view is that everything goes along really, really well. And that's why bond yields are higher than they are. US growth will be pretty robust. But the world is a mysterious place where things like COVID-19 happen, and then you need your bonds to insure your portfolio. You are getting paid to be there at the moment. The one caveat I'd really give is that the additional return you're getting for buying a corporate bond or a corporate bond fund is really, really low at the moment. So I do favour in portfolios having more of a sovereign bent than a corporate bent, because that's really going to help you with your downside protection. So I think they look good. As I said, New Zealand, bit more relatively attractive compared to global shares, and that's largely because of just how wide the breadth of expensiveness goes, particularly in the US, to a lesser extent globally as well.
When you talk about downside protection, I think it's worth thinking hard about that, because the one thing that I think's changed from in the last, say, 3 or 4 years compared to almost the whole of the rest of my career is we've been through a period of globalization, trade liberalization, internationally accepted rules. We're now into where economy kind of trumped politics. Mm-hmm. We're into an era now where politics trumps the economy and trade. So there is a lot of uncertainty baked into that. It can just be Trump saying something different every day, or it can be the Chinese economy's tanking so badly that they need to create a distraction and decide to invade Taiwan. You know, all sorts of things can happen when politicians rather than markets are driving things which you don't see coming. So I do think that while there's a lot of upside there in the US story, and I really take your point about New Zealand may not look very exciting, but if it's cheap enough, it's always exciting. I would be taking a lot of cognizance of the potential for something to come created by our fellow man and women, but mainly man, which will upend the apple cart and which has nothing to do with actual economic conditions and has everything to do with geopolitics.
On that note, I think we'll leave it there. Thank you so much for coming in and giving us those insights. And thanks everyone for tuning in. You can watch Shared Lunch on YouTube or follow us on your favourite podcast app. Leave us a rating and comment about what you'd like to hear next. And until next time, mā te wā.